You just got paid. You worked all month, 40 hours a week, maybe more, and finally, that direct deposit hits your bank account. You look at the number, and you pause, because it's not what you expected. It's less, quite a bit less. You do the mental math, your hourly rate times the hours, multiply by 4 weeks, subtract what you thought taxes would be, and the number still doesn't match. Something's off, but you don't question it, because this is just how it works, right? Everyone gets paid less than they earn. Everyone loses a chunk to taxes. That's just life. Now imagine a different scenario. Imagine getting paid, and the number in your bank account is exactly what you expected. No shrinkage, just the full amount. Feels impossible, doesn't it? Like a glitch in the matrix. But for some people, this is normal. For some people, getting paid looks completely different. They don't get a paycheck, they get something else. And that something else changes everything. Let me introduce you to 2 people. We'll call them Alex and Richard. Both make $200,000 a year. Same income, different structures. Alex works a job, good job, senior level, respectable. Every 2 weeks, a paycheck shows up. W-2 wages, the standard American dream. On that paycheck, before Alex sees a dime, money disappears. Social Security, Medicare, federal withholding, state tax, gone. By the end of the year, Alex has paid roughly $45,000 in taxes, maybe more depending on the state. The government took almost a quarter of everything Alex earned, before Alex even touched it. And here's the quiet cruelty. Alex worked for every single dollar of that $200,000, traded hours for money, sat in meetings, answered emails, commuted, and then paid the highest possible tax rate on every hour worked. Now meet Richard. Richard also makes $200,000 a year, but Richard doesn't have a job. Richard owns things, a business, some real estate. Richard gets distributions. Here's how it works. Richard's business makes money. The business pays its expenses. The business reinvests what it needs. And at the end of the year, the business has profit. That profit gets distributed to Richard. But watch the path that money takes. The business paid taxes on its profit first. Corporate tax rate, 21% federal, maybe some state. Then the remaining profit comes to Richard. But here's the part that stops people cold. That money Richard receives, it's not wage income. It's a distribution of after-tax corporate profit. And when Richard gets it, he's already paid the corporate tax. So his personal rate on that money could be 0, or a preferential rate, or structured in ways that minimize it entirely. Let's put numbers on this. Alex's $200,000 salary, rough breakdown: $200,000 earned, minus $15,300 for Social Security and Medicare. That's the FICA tax and employee portion, minus another roughly $30,000 for federal income tax, depending on deductions. Alex ends up with maybe $125,000 take home, maybe less, and that's it. Done. Taxed to death. Now Richard's $200,000 distribution. His business made $300,000 in profit. The business paid 21% corporate tax, $63,000 to the IRS, left with $237,000 in ARS. The business distributes $200,000 to Richard, leaves $37,000 in the business for growth. Richard gets $200,000. But here's the thing, that $200,000 is already taxed at the corporate level. So Richard's personal tax rate on it might be 15%. If it's a qualified dividend, might be 20%. Might be 0 if structured right. Might be deferred indefinitely if he doesn't need the cash. Richard pays maybe $30,000 total between corporate and personal. On the same $200,000, Alex paid $45,000. Richard paid $30,000. Same money, different structure, $15,000 difference every year. But it gets better, because Richard doesn't even need to take the distribution. He can leave the money in the business, let it grow, invest it through the business, buy assets through the business, and pay no personal tax at all, until he decides to take it out. Years later, decades later, maybe never, the money grows tax deferred, compounding without the tax drag that Alex's salary suffers. This is the invisible divide. W-2 income is the highest taxed income in America. You work, you get paid. The government takes its cut before you see it. Then you spend what's left with after-tax dollars. Then you save what's left with after-tax dollars. Then you invest what's left with after-tax dollars. And when your investments grow, you pay tax again. Double taxed, triple taxed, forever taxed. Now look at the other side. Business income gets taxed once, at the corporate level, at a lower rate, then distributed, at a preferential rate, or not distributed at all, and held in the business, where it can be used for things that would cost after-tax dollars personally. A car? The business buys it, tax deduction. Health insurance? The business pays, tax deduction. Meals? The business covers, partial deduction. Travel? Business expense. The business pays for things Richard would otherwise buy with his crushed after-tax salary dollars. This isn't a loophole. It's the system, designed to encourage business ownership, designed to encourage investment, designed to encourage capital formation, and completely invisible to anyone who only ever receives a W-2. Let's go deeper, because there's another layer most people never see. Qualified business income deduction, Section 99A. Sounds complicated. It's not. If you have a business that's not a corporation, you can deduct 20% of your business income before calculating your personal tax. Richard's business makes $200,000. He takes a $40,000 deduction. He pays tax on $160,000 instead of $200,000. Alex, no deduction, pays on the full $200,000. Same income, different tax base. The gap widens. Now add retirement. Alex has a 401k at work. Can put away $23,000 a year, pre-tax. Good. Richard has a SSP IRA, can put away up to 25% of his business income, up to $66,000 a year, pre-tax. Richard saves more, defers more, compounds more. The gap widens again. Now add health insurance. Alex pays for health insurance with after-tax dollars, or gets it through work as a taxable benefit. Richard's business pays for his health insurance, deducts the cost. Richard gets coverage with pre-tax dollars. The gap widens. Now add the car. Alex buys a car for $50,000. Needs $65,000 of salary income to afford it. After taxes, after Social Security, after everything. Richard's business buys a car, uses it for business and personal, deducts a portion of the cost. The car is a business expense, paid with pre-tax dollars. The gap widens again. This is why the wealthy don't take salaries. Not because they're avoiding work, because they're avoiding the tax structure designed for workers. The tax code has two tracks. One track for people who trade time for money. One track for people who own things. The first track is steep, uphill, taxed at every turn. The second track is gentle, slightly downhill, full of exits and shortcuts. Most people never even see the second track. They're told to get a good job, maximize their W-2, save in their 401k, and hope. But here's the thing, the wealthy didn't get wealthy by hoping. They got wealthy by understanding structure, by realizing that how you receive money matters as much as how much you receive, by seeing that a dollar earned through a W-2 is not the same as a dollar earned through a business. They're different species of money, subject to different rules, taxed at different rates, treated differently by every system in society. Let me give you a thought experiment. Imagine two identical houses, same street, same value, same mortgage. One is owned by Alex personally. One is owned by Richard's LLC. Alex pays his mortgage with after-tax salary dollars, $2,000 a month. Needs to earn $3,000 to pay it. Richard's LLC owns the house. The house is used for business, client meetings, a home office, rental to the business. Suddenly, a portion of that mortgage becomes deductible. Richard pays the same $2,000, but it's with pre-tax dollars. Same payment. Completely different cost. This is the architecture beneath visible wealth, not bigger incomes, better containers, not working harder, working smarter with the tax code, not avoiding taxes, just paying what's legally owed on the right kind of income. Now you might be thinking, the answer isn't quit your job tomorrow. The answer is start seeing your W-2 for what it is, a tax collection device, disguised as a paycheck, and then start asking different questions. What would it take to have one small side business, even a tiny one? Something that generates $5,000 a year in profit, that $5,000 can be structured differently, that $5,000 opens doors. A solo 401k with higher limits, business deductions for things you already buy, a different tax rate on a small slice of your income, a toehold in the other track. The wealthy don't have salaries. They have distributions. They have business income. They have capital gains. They have depreciation. They have deductions. They have structures. And every single one of those things is designed to keep more of what they earn, not by cheating, by using the rules that were written for them, by people like them. The question isn't whether you can become Richard overnight. The question is whether you'll keep playing Alex's game, not knowing that the paycheck you're so grateful for is actually the most expensive way to get paid, not knowing that the people who seem to have everything don't have salaries. They have something better. They have a system. And you have a choice. Keep trading time for money, taxed at every turn. Or start building something, anything, that pays you differently, that lets money flow through a different channel, that gives you access to the other track. The wealthy don't have salaries. Now you know what they have instead. The only question left is, what are you going to do with that information?